I went on interviews, and in the course of the interviews, I was very honest, and they said, "What would you like to do?" And I said, "Really, I'm interested in helping economic development within predominantly Black communities and low-income communities." He said, "Well, no, we really sell pharmaceuticals, or we sell oil." 100% of our loans are to individuals who make below median income in their specific areas. There's no question that the money that we are investing in is going to support lower income individuals who are buying homes. The irony is that in 2009, we had the best year, and actually we were managing money for New York City at that time. We were the highest performing investment they had in their whole portfolio. We made 10% from 2009 till 2011. We had stellar performance. Educating the community itself on how to use finance to solve its problems, because the advocates for the community, if they're not fully understanding of the economics, they ask and demand for the wrong things that actually discourage finance as opposed to welcome it.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Ron, really nice meeting you today. Thanks for coming on with me.
Nice meeting you also, Scott.
You grew up in Brooklyn, specifically in the Bed-Stuy, Crown Heights sections. Tell me what your childhood was like growing up there. I know that your parents were immigrants from the West Indies.
I grew up in the Bedford-Stuyvesant section of Brooklyn. It's a section of Brooklyn that actually in the 40s had a small but significant Black population, mostly homeowners who had migrated from Harlem because of the independent transportation line that was built. From 1940 to 1960s, that area went from 70% white to almost 90% Black. And so I grew up in a time in a neighborhood that was undergoing significant transition. And one of the things that was a significant factor is that I had childhood friends who moved out and new childhood friends that moved in. It went from predominantly home ownership to rental absentee landlords. There were a number of public housing developments that brought in large numbers of lower income individuals into the community. And I had to navigate those changes as I was growing up, learn how to deal with different people, new people, but also saw something that stuck with me, and that was the change in the character of the community, not so much because of the people, but because of the lack of services, the lack of care and sense of community that took place over that period of time.
Tell me a bit about your parents. They were both immigrants. What did they do, and what was your family life like?
So my parents came over as dreamers. They were both in their early teens or early adolescence. They came over both with single mother parents who worked in the garment industry. My father actually served in World War II, came back, also went to work in the garment industry. Started out as a runner and a packer, but eventually worked his way up so that by the time I went to college, he was a buyer for Kmart.
He actually did live a bit the American dream.
Absolutely. And he was afforded a lot of opportunities as he came back, was able to buy a home through the GI Bill, belonged to the union, was able to progress through the union leadership, and as a result of that, was eventually approached to become part of management. I was fortunate to have a role model and someone who worked hard, worked the system, but also was active in promoting change.
And both of your parents immigrated from the West Indies, is that correct?
Mother from Jamaica, father from Trinidad. That's a volatile combination if you know anything about West Indies, but it seemed to work for them.
So this neighborhood change you described, going from predominantly white to mostly Black, for international listeners, significance means that there was a decline in home ownership, you mentioned, but overcrowded living conditions and fewer services, absentee landlords, business closings, declining schools. So during this time, you watched everything kind of decline around you. What does that do to a child's understanding of how the world works?
To be honest with you, I didn't fully understand it, but what drove me, both in my education and ultimately my work, was to try to understand why that change took place and what could be done to change it. I basically, as a child, everybody is the same. When you play back then, our playground was the street and you met on the corner. I knew the characters were the same, the goals were the same, but it was a mystery as to why conditions changed so dramatically just because of the color of the skin of the people who were populating there. One thing that happened actually at the tail end of me living there is Robert F. Kennedy Sr. He became the senator of New York, and he was on his way to run for president. But in 1967, he started something called the Bed-Stuy Restoration Corp in conjunction with the Ford Foundation and a number of major corporations like IBM. And the goal of that was to recreate a sense of community and to restore Bed-Stuy to what it had been. And just in 1 year, I saw some of the actions that took place and the care, and it made me feel like there were things that could be done and that it was really the responsibility of the community and citizens to create the environment that you want to live in.
You attended the Brooklyn Preparatory High School, which is an all-male Jesuit school located in the Crown Heights neighborhood of Brooklyn. And you attended there from 1960 to 1964. And from what I know about it, it's a school with strong religious values and a strict dress code with ties and jackets, which you seem to have gotten rid of both of those for anyone watching us on video. So tell me how you ended up attending there, because I just got to believe that the majority of the people living in your neighborhood probably didn't go to this. I presume it was a fee-paying school.
It was a school, you're right, in the middle of the Crown Heights neighborhood, also a neighborhood that was going through the same transition as Bed-Stuy. My parents say one day, if you work hard, you can go to that school. And if you go to that school, you'll be able to get into a good college. It will open up a lot of doors of opportunity. They had a football field and a track field that was visible, but just a fence. As a youngster, I walked by there all the time and I saw these kids in football uniforms and in track running around, etc. From my early childhood, I also went to a Catholic school. So it was just a combination of a balance between, because I didn't go to public school in the first place already in a Catholic school. And since I was in a Catholic school, that seemed like the track I would take after getting out of elementary school. And it turned out to be actually a great background for me. One, the Jesuits had a strong social justice background. And this was a time when the Catholic Church in the U.S. was more focused on social justice than some of the other issues that have been to the forefront more recently. And so that gave me a great background, and I got a great education.
So it sounds like your parents, one thing they really did is they were very education oriented. I presume neither of them went to university before.
I was the first in my family to go to university. Actually, all of us in my generation were the first to go to college. Actually, my mother's best friend was Colin Powell's mother's sister, and Colin Powell was a role model for the family. And he went to City College and went into the Army. My parents said, you should become a doctor, go into the Army, and retire as a captain or a major, and you'll be set for life.
Yeah, so you've been a big disappointment.
It wasn't until I got an honorary degree from the University of Massachusetts with John Kerry that my father and other finally said, I see you made something out of you didn't waste it.
An older generation is like that. My father just passed away a couple of weeks ago, and he was 98, and kind of similar. He had a pretty difficult life coming up and had the same attitude. So eventually Yeah, you finally made something. But I guess the majority of the student body at that preparatory school wasn't from that neighborhood. Did you even know anyone when you went in there, or was this Catholic school you attending feeding that?
One other person that was in my class who was also African American, and actually he wound up graduating number one in the class and going on to Harvard. And they were in my class, I think there were only 5 or 6 men of color. It was all boys. That's another experience because I also ran track and enjoyed athletic competition. I had a lot of friends in other schools that I competed with and ran with. I had to learn how to live in two worlds. I had to learn how to live on the streets of Brooklyn and survive as opposed to being locked up in the home. And I was a joiner. I didn't want to feel left out, but I also had to learn how to adapt and deal with people who were not familiar with me and were not familiar and had a completely different background and an outlook on life in some respects.
Living in two worlds. Very interesting. Well, then after you graduated from high school, you went off to University of Notre Dame in South Bend, Indiana to study psychology. So why Notre Dame? Why psychology? And at that point, what did you think you might do with your life?
Actually, I went off to Notre Dame as a pre-med student. Rather than psychology, I took organic chemistry and vertebrate embryology. I was going to be a doctor. Midway, a couple things happened. One, I sort of realized after 2 or 3 years that I did all right in the subjects and managed to get fairly decent grades. I really didn't like it. I was more interested in other things. I also discovered that I didn't really like blood and disease. It didn't make me feel really good every day dealing with that. I switched to psychology because that was the one field of medicine that maybe didn't have to deal with that. And then I sort of realized I didn't like people who had psychoses either and wanted to spend the rest of my life doing that. So I kind of went through a transition of knowing exactly what I wanted to do to then not knowing what I wanted to do. It wasn't until I was asked to participate in a motorcade with Bobby Kennedy, who was coming to South Bend, Indiana to Notre Dame to make a speech about ending student deferments. So it was a pretty big speech. He was running for president. It was a week before the Indiana primary, which was an important primary. And my former roommate was working for him. He was at NYU Law School, and he and Rosie Greer, football player, Rayford Johnson, and Earl Graves, who was the publisher of Black Enterprise, were working as volunteers in the campaign. My roommate said, we need someone to be in the motorcade to go from the airport to Notre Dame. It's going to go through a predominantly white area that actually still had the Ku Klux Klan operative, and then a black neighborhood, and then Notre Dame. And I spent the day, I didn't know I was going to be in a car with Bobby and Ethel and the mayor, but I wound up with them. And I spent the day traveling from the airport, not the day, but an hour and a half, 2 hour drive through the streets of South Bend. The motorcade went from the South Bend airport to Notre Dame, but went through the predominantly white low-income area and a predominantly black low-income area. One area was populated by members of the Ku Klux Klan. The other area was heavily populated by community activists and almost like the Black Panther movement. It was quite a contrast. But what happened in both communities, what I saw was hope and aspirations that maybe this was a politician that would address their needs, and the same reaction from both communities. That was kind of inspirational to see that there was a possibility of uniting both communities that seemed at odds. Secondly, through our conversation as we went through, one, I also felt the compassion that he and his wife had and the desire to really make a difference. And he turned to me at the end of the day and said, if I get elected, I'd love to have you work with me to help make a difference. That was pretty powerful. As it turns out, it was also the day, I didn't say a significant part of my life then too, is that I had gotten married and had a child on the way. And when I went to home to my wife. She met me at the door and said, Martin Luther King was assassinated this afternoon. So there was two events in there, one spending the day with Bobby Kennedy and seeing Martin Luther King assassinated. I then was convinced that I was going to work with Bobby Kennedy and help change the world. 60 days later, he was assassinated.
What did the convergence of events, what did all that do to your sense of purpose?
I just renewed it, and I went to work in the poverty program that Kennedy had advocated, that his father had helped start and that Lyndon Johnson had put money into, and spent a year of social work. And I quickly realized that was really putting Band-Aid on a cancer, not very rewarding, because you saw problems that just continued in cycles and reiteration. I began to realize that most social problems have economic issues at its root and lack of opportunity. I also realized that I was a reformist, not a revolutionary. Through my psychology background, I realized that money and capital is a big motivator, and that maybe I needed to learn how to help redirect capital and provide motivation to communities to change through the access to capital and growth and wealth creation.
How did you discover this about yourself, that you were a reformist and not a revolutionary? Did you go into all this thinking you're a revolutionary?
I flirted with it, and I associated with some people who had some pretty radical thoughts. And basically, it came down to, did you think hurting other people was justifiable for a cause? And my Catholic and moral upbringing couldn't get me to that point. I don't want to hurt other people. I just want to help people. That led to reform, not revolution.
To put in context for people listening, this is right in the latter part of the 60s, when the height of this whole civil rights movement in the United States. And I think the program that you were working for was actually part of the Great Society anti-poverty program. Lyndon Johnson rolled that out in the aftermath of John F. Kennedy being assassinated, right?
Yes.
So that gave you a front row seat to the limits of good intentions without economic power then.
There was a woman who actually went to Notre Dame Law School. She was a Chicano, Mexican-American, didn't graduate, only had an 8th grade education, but the president of Notre Dame, Father Hesburgh, was visionary and was head of the Civil Rights Commission for U.S. He gave her a scholarship to go to law school, and she ultimately ran the poverty program under the Carter administration, but she was acting as a consultant and came to town. And she pulled me aside and said, Ron, what are you doing? And I said, well, I'm organizing the community and I'm working. She said, no, you have a degree from Notre Dame. You're Black. There are not too many people who have college degrees that are Black, much less from a university like Notre Dame. There's a whole world out there that we need to integrate and change. You need to take your degree and try to pave a way in the broader society and let people in the community organize themselves. That actually led to me serendipitously meeting someone who was trying to recruit African Americans to go to business school to get an MBA.
That's when you went off to University of Rochester in the Simon Business School for your MBA, right? That brought you back to East Coast, out of the Middle West?
Well, I thought it was the East Coast, but Rochester is more Midwest than
in the Midwest.
I was never good in geography. I thought Rochester was near Westchester, but it turned out it was 400 miles away. So I'd say Rochester was still the Midwest heading east.
You got your MBA and you got out of business school. Now we're talking around 1971, and you took a job in banking at the Marine Midland Bank, also in Rochester. So I guess you learned to love the winters. How did that job come about?
Actually, I had no thought whatsoever of staying in Rochester when I got my degree and was anxious to leave there as soon as possible. Although it was a lovely community at the time, Xerox and Kodak were in their heyday. I went on interviews, and in the course of the interviews, I was very honest, and they said, what would you like to do? And I said, well, I'd like to help the company. Really, I'm interested in helping economic development within predominantly Black communities and low-income communities. And they said, well, we don't really do. I saw their ads that they said they were interested. And so I said, I want one of those jobs. They said, well, no, we really sell pharmaceuticals, or we sell oil, or we sell. And finally, I had a dinner with the president of Marine Midland Bank in Rochester. They were a sponsor of the fellowship, and they invited the four of us that had fellowships to dinner. And I kept on telling him that he should be making more loans in the Black community, and he should be doing this and doing that. And he turned to me and says, I have nobody in my bank that thinks that we can do business in that community or it's worthwhile. But if you can figure out a way to make money and to do it, you would help Rochester in general, because the city would be more wealthy and less problems. You would create a new market for the bank. And we're actually in the business of helping communities grow and make money. So what you want to do is not too far off for what we do. But there's only one problem that we have. And I said, well, what's that? And he said, you don't know anything about banking. So he said, if you are willing to come to work, I will make sure you learn and are exposed to whatever you need to know to be a good banker. I can't promise you what will happen. I can only promise you that you'll get the education and learning. We have no Black supervisors. We have no Black loan officers. We actually don't have many people of color that work at the bank at all. So it will be a challenge for you, but we'll never know what happens unless you try to take that challenge.
This man was Rod McDougall.
Yes.
And he became a mentor for you, had a significant impact on you. Somewhere along the line, he taught you about collecting what he called shiny marbles. Very insightful words for someone around 25 years old or something like that at the time. It certainly changed the course of events for you. While you were at Marine Midland, you had the opportunity to lead a project to build a couple hundred unit low income housing development in an under-resourced area of Rochester with a community organization called Fight. Tell me about that experience.
There was a minister who ran a fairly well-known community organizer, but built on this Saul Alinsky model. He started something called Fight Inc. There's a Harvard case study that was developed because they took on Eastman Kodak and actually won concessions with them around what Eastman Kodak would do in the community. But he came to the bank and wanted two things. He wanted a mortgage for his family, and he wanted help to build a shopping center and a housing project within the section, the third ward, which was a predominantly Black area. And so Rod called me up. He wasn't sure we could do any of it, but he figured if anyone was going to try to do it, and also if we couldn't do it, then he could at least have me tell the Reverend that we can't do it.
Let him down easy.
One person of color telling another person of color, this is not going to work. I won't go through all the details, but the bottom line is that I learned a lot about mortgage financing. I learned a lot about building shopping centers, etc. He bought a house. We built a shopping center, and we did a 250 unit low income housing project. It was a great experience for me, and it was one of my first early successes.
I'm going to take a quick jump ahead, and then we'll come right back to this. 20 years later, you happen to go back to that same Rochester project and actually found it in ruins with gang activity, drug use, had pretty much deteriorated. How did you feel at that point, and what did that teach you about sustainable impact?
That was a teaching moment. I actually was invited to come back to the University of Rochester, and I took the opportunity to go to see Fight Square. And they said, oh, you don't even want to go there. It's not a good neighborhood, and et cetera. And I said, what do you mean? I helped build it, and et cetera. So I went there and I witnessed it, and it taught me a lesson. It said that building community is not about building buildings. It's about building support, opportunity, character. There's brick and mortar, but there's also community building. And unless you have all of that together, you're not going to change the opportunity and the characters of communities.
It must have been a very impactful moment for you to see the fruit of your labor. It didn't exactly give you the fruit you wanted. Learning moment. And in 1979, you were around age 32. You became the chief operating officer of Freedom National Bank of New York in Harlem, which was the largest Black-owned bank in the United States at that time. How did that move come about, and what did you learn there about the challenges and opportunities of serving underserved communities through banking?
One of the themes I want to mention too in this is how certain individuals and mentorship and guiding can be critical. Because I'll circle back to Rod McDougall, who eventually left Marine Midland, ran the second largest bank in Boston, and then became treasurer of Harvard Corporation. Well, he was quite successful, and that circles back to another opportunity when I went to Boston. I was working at Marine Midland. Somewhere along the line, I mentioned I was in real estate lending, small business lending, but I had by this time 2 sons and a family to support. One, I wanted to get back to New York City. 2, the area of the most impact within the bank for career building was in the corporate banking side. And so I arranged to get transferred down to New York to work on the corporate banking area. I covered New England. My next door neighbor, he was a vice president of American Express, African American. He had run the bus company for New York City for a while, and he was an early graduate of Harvard Business School, so he's fairly successful. And he was on the board of Freedom National Bank, but I'd see him on the train riding down to Wall Street in the mornings, and he would tell me all the things about what was happening at Freedom National, and he kept on saying every day, "You need to come to work for Freedom National. We need your help. We need your help." And I said, "Oh, I'm doing corporate banking." After 2 years, I thought I was going to get a promotion at Marine Midland Bank, or I had a deal that I wanted to do. That was a fairly big deal. It was a takeover deal, and the bank didn't want to do it, not for credit reasons, but for political reasons. The president of the bank called me up and said, "We're not going to do the deal, but you're a good soldier. The captain has to do what the general says. And when I'm convinced that one day you're going to be a colonel or major." He didn't say I was going to be a general. I had been there 3 years in the same job. And finally, my neighbor told me, "Look, I'm going to talk to David Rockefeller, who, let me roll back, Goldman Sachs, Chase Manhattan Bank, Morgan Stanley, and Equitable Life Insurance had put together a pool of money to invest in the bank to help continue it because they'd run into difficulties in the 70s. But part of the deal was that they would send people up to help run it. And so my neighbor said, "I'm going to ask David Rockefeller to call up the CEO of Marine Midland and tell them that we'd like Ron Homer to go up there to help." He called me on a day that I was upset, and I said, "Yeah, go ahead and do it." And he did. And I wound up taking a 2-year leave of absence to go up and help run Freedom National Bank. During that time, it actually became very profitable, so profitable that there was a fight over control because, circling back, these things all come together. Bed-Stuy Restoration Corp owned a major block of stock that they had bought through a grant from the federal government, and they wanted to sell it so that they could get the cash to do the things that they ordinarily do. And there was a big fight over who was going to be able to buy it because whoever bought it could control the bank. They developed a whole fight over it. It actually was written up in the Fortune magazine. I wasn't the president. I was the number 2, but I talked to the president. He said, "We should buy it because we're the ones who are making the money." He didn't want to do that for whatever reason. And there was a fight for close to a year over a battle for control. And I decided I'm going to leave there and find another situation where I can get control of the bank. That's sort of what led me to this bank in Boston that had been closed by FDIC, but run by them for 10 years. There was a Black-owned bank. They wanted to either close it or sell it to someone. There was a group in Boston, they wanted to buy it, but they were told they couldn't buy it unless they found someone that FDIC liked to run it. They approached me, and I said, "Well, yeah, I'll do it, but I'd have to own it myself." They agreed to that. And so I moved from Freedom National Bank to Boston to establish a Boston Bank of Commerce.
You worked there for some years, but at one point you were back at Boston's Logan Airport, and a baggage handler there recognized you. Tell me about that moment.
The principal focus of our bank, because of the background and early experience I had going back to Bed-Stuy, was home ownership and small business development within the predominantly Black communities, because I felt those were bedrocks in building communities. And it turned out the Federal Reserve Bank actually did a study in Boston on mortgage lending. And our bank, which was 0.1% the size of all the other major banks, made 35% of all the mortgages to Black and Latino in the period. So we were pretty active in home ownership. And one of the most rewarding things was that I'd meet everyday people who would stop me and just say, because of your bank, I was able to buy a home, and that home has been really important. We took out a mortgage to send our kids to school, et cetera. So it was just a testimony to the impact that, and this is a case where owning a building, but depending on who owned it and their motivation, and that it could be life-changing and impactful.
And you were getting your luggage, and one baggage handler came up to you and recognized you.
I went to tip him. He said, "You can't tip me. I got my loan from you. So anytime you come, you just look for me. Your bags, don't worry, it'll be on."
That had to make you feel like a rock star.
It did, except that a couple of years later, I had left the bank and was doing something else. I was actually had started this investment company, so I was no longer that visible, and I wasn't running the bank anymore. And I went through, and a TSA person looked at me and said, "Didn't you used to be Ron Homer?" That brings you back to life.
One other thing I wanted to comment on during that period is around 1994, you advised Harvard Business School professor Michael Porter in forming something that was called the Initiative for a Competitive Inner City, also known as ICIC, just to enter into the record that we've always loved acronyms in this business. The ICIC is a research organization focused on attracting private sector investment into underserved urban centers. How did that collaboration with Michael shift your thinking about scaling impact beyond individual institutions?
I wouldn't say it shifted it. I think I always had that. I just wasn't in a position to direct it. What happened is Michael Porter and I were on a task force to help the governor lay out a blueprint for Massachusetts as a state and what the state government could do to build capacity within the state, and focused on financial services, biotech, education, healthcare. So we came out with this report, and part of the report was a program to help older cities that were manufacturing that had now were facing problems because companies were leaving. And the remedy that they had was to build a garage on a parcel in Roxbury. I had part ownership of that with the bank, but I said, "This is crazy. You have all these programs to support all these other industries, which are going to be successful anyway, because we have Harvard and MIT and all these resources and capital. But the areas that need the most help from the state, you really have no plan." It was just at the time that there were riots in LA over the Rodney King incident. Porter said, "My students have been talking to me about doing something." And you're right, there is no really study specifically on how to build capacity in these communities. And a lot of the advocacy for the communities are advocating for the wrong thing. They're trying to promote these cities because they need help and because they have all these social issues. But actually the way you attract capital is by promoting the assets, not the deficiency. There are a lot of assets in these communities: labor supply, cheap land, proximity to hospitals and education and institutions, close proximity to transportation. He said, what we really need to do is to come up with a plan that builds on these competitive advantages that are there. And then two things need to happen. One, we need to educate the community on how to sell itself. And secondly, we need to educate the private sector on what's available there. Walter Wriston, who many of your listeners won't remember, but he was the CEO of Citibank when it started to go international. And they him one time, how do you decide where you go? And he says, capital goes where it's invited and stays where it's welcomed. That's part of what ICIC is about. That's part of what we try to do in the impact investment strategies at RBC, is that to figure out how to invite capital and how to help that capital make a return that will want it to stay.
Then a couple of years later, in 1997, you co-founded Actis Capital Strategies and created what many people consider to be the very first registered mutual fund that was focused exclusively on community development. So you essentially invented a new category. Tell me how the decision to leave and co-found your own shop came about, and then what was the opportunity or the problem that you were trying to solve that no one else was addressing at that point in time?
It's ironic how these same people come into your lives. Joe Kennedy was a Congressman Kennedy's oldest son, and he was a big advocate for this Community Reinvestment Act, which was being the regulations, which said that in order to expand, banks had to show that it was adequately serving the communities in its existing footprint. This is a time that banks were merging and gobbling up each other. Joe Kennedy, he actually created an act called the Home Mortgage Disclosure Act, which required banks to disclose where they were making their mortgages. And if they weren't making their mortgages proportionately, then that could be used to prevent them from a merger or an acquisition, etc. I was involved in actually trying to help write the regulations for that because I had been active in mortgage lending through my bank. Because I had a close relation with Joe Kennedy, the industry itself recruited me because they said, well, we need someone to educate Joe so that we don't go bankrupt doing this. What we really want to do is to be successful. So I was sort of like the go-between between Kennedy and the community and the banking industry. And in that process, a couple of times, right after as part of that, banks would come to me and say, look, you're making these loans. Can we buy them from you? But then we could get stuck on the price because they said, well, we don't know about the credit. We don't know this. And I found out that if I could get Fannie Mae to guarantee the loan, instead of selling the loans at a discount, I could get a premium. Well, I went to Fannie Mae and said, gee, I want to be able to get your guarantee. I had developed a relationship with Fannie Mae to do all of this. I was approached by some of the banks that your bank doesn't have much capital. We got all the capital in the world. We now have a mandate to do all the things that you've been doing. We're either going to buy you or put you out of business because we're going to just follow your blueprint. Why don't you figure out a way that we can marry your experience and your expertise with our capital and then help all of us. I went to Fannie Mae and I talked to them about it. That's how we set up Access Capital. Fannie Mae was being pressured to guarantee more of these loans, being pressured to make them. I knew from my own experience that these mortgages would actually perform better than traditional mortgages. Because part of the value of a mortgage is that when rates drop, if it's a 30-year fixed rate, if people pay off right away, you lose some of your advantage. If they don't pay off right away, and I knew from experience that lower balance mortgages and mortgages to working class and lower income people don't refinance as fast. It's not economically justifiable for them to do it. They tend not to move. They tend to stay in those residences a long period of time. So from a financial standpoint, if you could accumulate these loans and put them into a package and have investors, and also you have less risk if you own 1,000 mortgages than if you own 100 mortgages. I had this theory that once we did this and we could assemble them, that they would outperform from a financial standpoint. And that's proven to be true. We started in 1996 and we've consistently outperformed the benchmark for mortgage-backed securities.
But that wasn't the end of the story, right? You created a mutual fund. So what did you do? Take these, package them, securitize them?
We work with the lenders. So because these loans outperform, theoretically, the lenders should get a premium for them because part of the pricing is, I don't want to get too technical, but there's an embedded call option in every mortgage loan. The buyer can prepay whenever they want. So part of the value is how you value that call option. And if you think it's going to be early calls, it is valued less. If you think it's going to be late calls, it's valued more. And we wanted to take that premium, and the market, actually Wall Street understood that. And they actually paid premiums for some of these when they were put into mortgage-backed securities. And I wanted to find a way to translate that premium to offset the perceived excess costs of originating those loans. It obviously costs the same to originate a loan. You're going to make more money if the loan is for $1 million than if it's for $10,000. So the whole theory was to work with originators to incent them or to compensate them for trying to market their mortgage products in communities that they otherwise might not be interested in.
This is late, very end of the 90s, early odds. How did you convince institutional investors, who are people who care primarily about returns, that investing in underserved communities could actually make them money? What was your pitch? Was it Fannie Mae's backing these up, or what was it?
One, I had Fannie Mae backing it up, so the investors said they must know something about the mortgage market and what this woman is saying.
Not always true.
And the banks were, you have to remember, this new rule came up. So the banks were my early investors, and they came to the table because of regulatory issues. But after 3 years, we developed enough of a track record to prove our theory. And our first really big client was New York City Retirement Systems, which is the third largest public pension fund in the United States. And we actually convinced them that they wanted a vehicle to help their retirees and their workers to buy homes in New York City. And it was the height of predatory lending. They decided to give us money to work with Fannie Mae to incent lenders in New York City to make loans to policemen, firemen, people who work for the city. And we were able to show them the track record. I don't want to get too technical, but New York City mortgages have slower prepay because there's a mortgage recording tax when you refinance, et cetera. So we actually were able to help the pension plan take advantage of that and invest it in loans. But in general, we were able to grow the fund because if you tell people you own Fannie Mae mortgage-backed securities anyway, if we can arrange that those securities are in neighborhoods that you care about, why wouldn't you own Fannie Mae mortgage-backed securities that support mortgages in your community versus some bundle of mortgages that might be 10 states away or 1,000 miles away from where you are?
What was your footprint where you were investing? Was this very heavily New York area, or did your footprint grow?
The unique part of our program is that we told investors, you tell us where you want the mortgages made, and we'll invest your money there. So even in the mutual fund, you buy shares in the mutual fund, but if you want it in Idaho, we'll find loans in Idaho for you. But then if you have different investors in different communities, now you have the diversification because investors are spread out and they want different communities, but you are able still to put each individual's investor in the community. So you get the commingled return, but you get the satisfaction of your money's going into the communities that you're interested in.
So this was a pioneering effort. 11 years later, around 2008, I don't know if 2008 has anything to do with when this occurred, but Access Capital Strategies was acquired by RBC Global Asset Management. So maybe for people listening who might not be familiar, give us the overview of RBC Global Asset Management and what led to them acquiring you. Then what was your role there?
As part of our growth, we actually worked with larger firms to do some of the back office operations in terms of trading rather than build our own infrastructure. Our expertise was going out and finding the mortgages and working with originators, but the back office, I didn't want to spend money building an infrastructure. So we had a partnership with Merrill Lynch. They were acquired by BlackRock. That happened. We understood that we were going to be even a smaller fish in a bigger pond, and it was going to take a long time. And BlackRock actually said, we don't know if we can continue to do this because we have so many different clients. So we went out looking for another partner. We found RBC, who was trying to grow their business in the U.S. in this area. We hired them initially to do our back office. They got excited about the overall product and said, we don't want to just do the back office. We would like to own it. My partner was enthusiastic about that, and the bank, through an offer, made it hard to refuse. So we hired him in 2006 and sold the business to them in 2008.
So it had nothing to do with the impending.
No, ironically, when the world blew up, it helped because aside from our individual investors, because the investors when we started the firm was Michael Porter, Peter Lynch, Fannie Mae. So we had some pretty credible investors, but it certainly helped at that time to be owned by one of the banks that was least affected by the meltdown, a bank that had plenty of capital, was not embroiled in any of these mortgage issues, etc. And the irony is that in 2009, we had the best year, and actually we were managing money for New York City at that time. We were the highest performing investment they had in their whole portfolio. We made 10% because I told you about this prepayment. Actually, the problem, people who had 30-year fixed rate mortgages that were buying them for shelter didn't default on their loans, but they also couldn't refinance at that time. So rates went from 8 or 9% to 3%, 2%. And the value of those mortgages went up. Our prepayment rate was a lot slower. So from 2009 till 2011, we had stellar performance.
Tell me a little bit about RBC, why they wanted to develop something like this, what was going on there, and give an overview of RBC Global Asset Management. I mean, they're huge, but tell me, where does this piece of the business live within the overall? Because RBC is not a pure impact community investing play.
RBC it was actually called Voyager Asset Management, and they acquired Voyager sort of as an offshoot as to combined wealth management platform called Dane Rochester, which is sort of like the bedrock of RBC's wealth management business here. And originally, the expertise of the asset manager was investing the bond proceeds from the debt that their capital markets teams were issuing. And so they had a strong fixed income background, and they were looking to expand their fixed income capabilities. Of course, they're competing against PIMCO and BlackRock and all these other big names. And so they thought that this product would help use their skill set, because they had a skill set in this area, but would be a niche that would help differentiate them from a PIMCO or BlackRock or any other big fixed income investor, and would open the door and at least give them a foot in the door to explain their other capabilities. So that's how we initially fit in terms of RBC Global Asset Management. We're still in the fixed income side with RBC BlueBay and a lot of their products. We're a boutique niche product, something that we can go into a client and say, here's a solution to maybe a problem that you want. You'd like to do more impact, etc. And it's been successful. One, we've had a lot of satisfied clients. We've got into blue chip clients that ordinarily might not seek out a smaller shop. And then from that, we've managed to sell other products that are more traditional.
Paint the big picture. What's the total AUM that you could say is dedicated to community investment impact strategies?
We're about $2.5–3 billion. That was at a time when our U.S. assets were maybe 70 or 80 billion. A lot of it short duration, and our fees are so even as $3 billion in terms of revenue, it was at least from a U.S. standpoint, it was in the area of 4 to 5% of revenue.
What has changed and what's remained the same since the acquisition? Does the Access Capital legacy continue today within RBC's broader institutional framework?
Yes and no. It still has a role. We're actually working on a couple of projects now that will be, we think, innovative. I think one of the things that more recently we have been focused on is working with smaller originators that are mission-based and helping them access the secondary market. Most of them have been closed out. So part of what we're trying to do is to build capacity to empower smaller lenders who are interested in some of these underserved communities to gain access to the secondary market. Originally, we're focused mostly on housing because that was where the bonds are. With COVID, small business has been more focused. The SBA, that used to be a fairly sleepy organization, it may turn back, hopefully not. It became more important because of COVID. And so there's been a lot of new programs around small business lending. It's a big issue in the United States now. There's going to be a lot of impact with tariffs. So we're looking at a program to help some of these lenders access the secondary market to sell off their SBA loans.
You are today the chief strategist for U.S. impact investing at RBC. I've had a colleague of yours on the show a couple of years ago, Mark Dowding, on the Blue Bay side in London. He's in fixed income and more in sovereign debt.
He's my boss's boss. He's the CIO for all of our fixed income.
He was on the show, and most of his focus seemed to be on sovereign debt, and he had an SDG fund that he had started at the time. Great guy. How does U.S. impact investing fit with the other kind of fixed income responsible investment?
We're all in the same group. We have a lot of products in that group, and we all compete for Mark Dowling's interests. Where we fit in is that we're one of an array of products, and it's up to the teams to come up with new ideas that make money for our clients, but also make money for RBC. That's part of what my job is, to figure out where are the opportunities to take our impact investment theories where we can actually make money and attract clients.
That's the perfect time for you to explain your theory of change to me. So tell me, how do you actually turn mainstream fixed income markets into engines for community development?
The same way fixed income markets have helped build other communities. If you look at how America's suburbs and different areas have grown, it's been supporting home ownership, supporting infrastructure investments, helping small businesses locate. Part of my job is to find lenders who are interested in these communities, to work with them using, in many cases, existing government programs that just haven't been applied to these areas because no one's taken the time to market in those areas, and convincing them that by focusing in these areas, there'll be a lot of capital to support what they're doing. They can actually find new markets and be successful. There's plenty of viable transactions, and to help increase the supply of capital that's going into those communities. It's not recreating the wheel. It's just applying grease to a wheel and pointing it in a different direction.
All of this is targeted towards institutional grade investments, I believe. I think you work with mortgage-backed securities, SBA, Small Business Administration loan securitization, municipal bonds. These are complex financial instruments and institutional grade. For someone who doesn't live in that world, how do you take something like a mortgage-backed security and engineer it to deliver targeted community impact with real results and outcomes while still maintaining the institutional grade status and returns?
Like you mentioned, many of these individuals, if they bought an ag product or any ag benchmark product, they're going to own these already. We're not requiring them to buy something that they don't already have an allocation. We're just saying that you can not only allocate it generically, but you can create product that have a more specific target than the generic target. So part of our ad is not so much taking on more risk. It's really just applying some of these tools and getting them applied in areas that they haven't been applied to previously. A lot of this goes back to where our discussion first started. The reason I learned later on that Bed-Stuy went from high home ownership to lower home ownership was that FHA wouldn't guarantee mortgages made in predominantly Black communities. Was they thought that the value of those homes were going to go down. When the previously white homeowners were moving to Queens, which is another suburb in New York City, and black wanted to come in and buy it, they couldn't get mortgages because times have changed and some of those barriers have disappeared. All we're trying to do is apply the same thing that helped people go from Brooklyn to Queens. And ironically, Bed-Stuy has become gentrified, and it's now maybe 50-50 for black and white.
Let's talk about the measurement challenge. We all know that impact investing has had tremendous growth, but with it enter some charlatans and credibility problems, and we're all familiar with things like impact washing. But you've developed loan level mapping and measurement processes. So tell me, how do you prove that your investments are creating real additional benefit for these communities?
We prove that for every dollar that we invest, it's being used to support a specific home or a specific project. So there's a direct linkage. Overall, we can look at the makeup of our mortgage lenders, but I think our biggest impact is when we work with lenders who are specifically targeting these areas and who are creating opportunity. And when they choose to sell loans to us because they can take advantage of the premiums, and where they tell us having this product really helps us make more of these mortgages and incents us to make more. I wish I could say that we've been so successful. There's only so much you can do with $3 billion given the $200 trillion market. When we track where our mortgages are and the communities that they are, and most of them are to people who make below 80% of the median, those areas tend to be more stable and be the developing areas.
You've developed some rigorous methodologies, and I think it's aligned with the GIN's operating principles for impact management. So maybe you can walk me through how you track and quantify impact across your portfolio, because you report on this.
We have corporate clients who have come to us and said, we have $50 million and we want to invest in these 3 cities because that's where employees are. And we actually customize mortgage-backed securities made up of loans in the communities that they designate. And we issue quarterly reports showing for every dollar we have from them, where those dollars are, what mortgages it's supported, what the income level of the person who's buying a home, the census tract that they're located, whether the census tract is low income, moderate income. We give them loan level demographic data. So we can show that if you look at our overall portfolio, maybe 65 to 70% is to BIPOC homeowners. Which if you took the universe of home ownership in the U.S., that would be way out of proportion. That percent would be more like 15 or 20%. And 100% of our loans are to individuals who make below median income in their specific area. There's no question that the money that we are investing in is going to support lower income individuals who are buying homes.
I know you're securitizing and packaging these things up, but can you give me maybe 1 or 2 examples from your portfolio that stand out as a good demonstration of measurable positive impact that your activities have had?
If you went to New York City Retirement System's website, they track the money that we've done and the amount of loans we've made in the 5 boroughs and the income levels, etc. We probably own maybe 10% of the overall mortgage volume in the city of New York, and it's to the people at the lower end. We can give data over time on how much we've invested, and because these loans pay down and we reinvest the proceeds, and some of them pay off and we reinvest the proceeds, the actual impact is greater than the actual initial dollars invested because it rolls over. We probably financed well over 50,000 individual homes and probably tens of thousands of multifamily units.
Do you ever have to balance financial returns with community outcomes in practice when you get down in the weeds to making some of these financings?
The short answer is no. Actually, our goal is to outperform because we're solving these problems. Where the sacrifice comes, if you want to say sacrifice, is that it obviously cost us more to create these mortgage-backed securities than it would if we just bought them on the open market. If you bought them on an open market, it's 10 seconds and you put a bid in. If you work with a lender and you hand select the loans and you put in, that takes manpower. So I wouldn't say our clients don't see the difference in returns. It's the cost that it takes to execute the strategy. But this is a business that once you create an infrastructure to do that, the added value as you do more is less. And so over time, it becomes more profitable as you build it.
You've been doing this a long time. What's the hardest truth you've learned about trying to use finance to solve social problems?
That the failure has not been that it can't. The failure has been that it hasn't been applied strategically and consistently enough. So I think the most frustrating thing to me is not that it's hard, it's the willpower and the desire to take the time to do it. That's what's disappointing. One of the issues of using finance to solve problems is educating the community itself on how to use finance to solve its problems, because in some respects, sometimes the advocates for the community, if they're not fully understanding of the economics, they ask and demand for the wrong things that actually discourage finance as opposed to welcome it.
So there's an education process?
Yes, because if you have a community that thinks that the only way to get money is through concessions, that's not going to work over a long time. And the community doesn't really need concessions. It's just sometimes people have adopted an understanding or just a lack of familiarity that they say, well, I'll never get it traditionally, so I'm going to try to get it another way.
Somehow an inferiority complex?
Similar. They just haven't learned how to adopt it. Because I've lived in both of these worlds, I fully understand that they're more than capable of doing it. I did learn a lesson when I was running the bank. I was at a meeting and people were complaining about getting financing and mortgages for their small businesses. One of the best compliments I've ever gotten was someone jumped up and said, look, Ron Homer's here. If you go to Ron Homer and you try to get a loan and you don't get it, it's not because he's discriminating. It's not because he doesn't like you. It's because you don't deserve it. Part of the problem in access to capital in some of this community is just a lack of trust. Because I could tell you sometimes I just applied for a loan with a fairly large bank who I knew the CEO and I've done tons of business with them. But I was dealing with a fairly low-level processor, and I was dealing with it for weeks, answering questions that were pretty irrelevant, but I could see that she had a checklist and just wanted these things answered. I was at the point I was just going to forget it. I'm going to go somewhere else. I'm not going to even bother because I don't really need this. And finally, I just dropped the note to the CEO saying, gee, I tried to do this. Within a half hour, one of his staff called me, blah, blah, blah. I had the loan the next day.
This education process, it's a self-imposed obstacle, I suppose, with some of these communities.
It's education and trust.
How do you get around that, or how do you instill trust? How do you educate them?
That's a great question. So during the last 4 or 5 years, there's been a growth of community-based lenders. Some were started out doing concessionary loans, but gradually were let into the window to do secondary market, traditional capital markets loans. And I think one of the solutions is to empower those institutions to have access to some of the products that larger institutions have, as long as they apply them to these underserved communities. So there's a certain threshold, like with Fannie Mae, you had to be a certain size, et cetera, before they allowed you to be a seller servicer or to do something. Same thing with SBA. You had to be a commercial bank. You couldn't be an independent lender. There were unnecessary barriers there that can be broken away. So some of it is regulatory. Some of it is, like I said, it goes back to a will of, do we want to help these communities become a more integrated part of the financial system, or do we want to treat them as islands?
Ron, you've been doing this for 28 years now. How has the appetite for impact investing changed, and what's driving institutional investors to care about this stuff now as opposed to when they didn't before?
I've actually been involved in doing some of these things for almost 50 years, I hate to admit. And what I've learned over time is there's an ebb and flow. And sometimes the appetite is greater, sometimes it becomes less. A lot depends on the overall economic environment. Obviously, when things are booming and people are looking to expand and they want to take the time to other markets, then they'll pay attention because it's added value. I would say we had a heightened ebb over the last, say, from COVID and after the Black Lives Matter movement. And now I would say we're entering into a low flow period. Even in the lower periods, there are certain contrarian investors who then will still be there. So there's always a core market that is fully committed and understands its value and continues. There's a medium market, and then there's one that comes and goes with the winds.
You said that building houses isn't enough to create change. What's the missing piece that most people don't understand?
I think it's like any social program. It's instilling within individuals the sense that there's opportunity if they apply themselves and want to take advantage of it. I think a big problem is sometimes groups of people or people just give up in trying because they don't think it's going to succeed. Going back to my psychology days, there's a behavioral experiment which they call conditioned helplessness. And it's essentially a Pavlovian theory that if a rat can't escape a shock, it just learns to accept it and just waits. If it can't escape, it will jump over a bar and do a lot of things and it'll get out. That's part of how communities suffer. So the reason I think home ownership and small business is important because those are beacons within these communities to show the way for other people, and it helps set the character of the communities. If you have one or two people who take pride in their home and who take, who do little things to improve it, maybe that becomes 3 people and 4 people and 5 people. That's what happened when I mentioned Bobby Kennedy, Bed-Stuy Restoration. He started a program where they painted the doors on all the houses if you wanted and gave them a garbage can. And that changed a whole way of how people looked at communities. You could see the blocks in which that happened.
Looking ahead, where do you see the biggest opportunities in impact investing, and what innovations could unlock significantly more capital for underserved communities?
I think the biggest opportunity is addressing the growing gap in wealth. And so I think the opportunity is to come up with solutions that help narrow those gaps. And that involves a lot of different players. It's like Henry Ford when he invented the car, and maybe AI will present some opportunities in that, but as benefit to develop enough people who worked in the factories who could buy the automobiles, and they expanded the market for those automobiles. So there's a lot of poverty in the world. There's a lot of potential consumers in the world. There's a lot of people who are underutilized and underdeveloped. And I'm enough of an optimist even at this age to feel like there's opportunity in helping those people develop.
You grew up watching your community decline in real time. At what point was it that you realized you could actually do something about that and make a difference?
It was the impact of that program, the Bed-Stuy Restoration. It was seeing that someone cared, that you should take pride in your community, and that there were opportunities. Along with that program, there were youth programs, there were educational programs. There were things that just helped show that if you adopted certain behaviors and if you did certain things, that there was a reward right there for you for doing it. So a lot of these youth programs, you had to behave a certain way to get involved in it. You had to come prepared. You had to do certain things. But because it was real, and because peers saw their other peers going and play basketball, going to see games, going on outings, going on trips, They said, hey, I want to do that too. What do I have to do in order to do that?
If you could go back and give your 25-year-old self one piece of advice about building a career in impact investing, what would that one piece be?
Spending more time trying to bring other people along rather than trying to do it by myself. One thing, communicating, developing better communication skills, because you can have the best cure around, but if you can't communicate it and convince other people, and being a little bit more humble, I guess.
Was there a cockier version of Ron Homer out there at one point?
Maybe I was a little too aggressive in trying to convince people that this is what should happen as opposed to soft gloves. But when you're young and you want to get things done, you attack.
Understood. I've been there. Ron, I've got a few last rapid fire questions for you before we wrap up here. And don't overthink these and just give me whatever comes to your mind. Or if nothing does, feel free to take a pass. That's okay too. If you had to name the single most important challenge in the impact investment space at this point in time, what would it be?
Faith that it's possible. Hope and faith that things can work, that there are real solutions to some of these problems.
What do you know now about community development investing that you wish you had known when you co-founded Access Capital Strategies 28 years ago?
I think the major thing is I know how hard it is to get people to adopt something different, even when it's in their best interest or when I perceive it's in their best interest. So again, spending more time communicating and convincing people of what you want to do rather than just trying to do it in a vacuum.
This is an investor podcast, so I always ask this, and we all like to go to dinner parties and talk about the winners, but you don't have to name names, but can you describe an investment you made that you were convinced of at the time you invested it, ticked all of your impact boxes, but in the end it didn't turn out, and what was the lesson learned from that experience?
It was building low-income housing where you just warehouse a lot of low-income people in a development without support.
Without building a community.
Right. That clearly hasn't worked.
Conversely, can you describe an investment that you had some level of skepticism about, either that made you pass on it or you just were skeptical that this was going to work out, and in the end it actually performed way better than you expected and you were happy you invested, or if you passed on it, you regretted doing so, and what was the lesson learned from that?
I've actually been involved in some investments independent of Access, but as part of my work in the bank that actually finally worked, but it took 15 years. Which is, most people won't wait around, but it's essentially linking the development of a major parcel of land in Roxbury, Mass., which was predominantly black area, with another parcel of land that was in downtown Boston. And the concept was, in order to attract the capital to go into the lower income area, you marry it with an investment for downtown. Ironically, we got the building built in the low income area faster. The downtown market crumbled for a while, and it took time to get the market back up in time. It accomplishes its purpose in that it got the development in the lower income done, but in terms of the financial rewards, it didn't come until much later, when the downtown development, which turned out to be the headquarters for the State Street Bank.
What is the lesson learned, that good ideas sometimes take time, or what's your takeaway from that experience?
Well, I think in everything, perseverance and adaptability and flexibility, moving around. But one of the lessons learned is that every plan that you lay out can depend on a lot of variables that are beyond your control. And when those variables change, and when headwinds change, you have to have some adaptability and figure out how to move, because some of your assumptions are no longer valid. This could be simple as interest rate scenarios or overall growth in the economy, demand. Particularly in real estate development, it takes such a long time between when you start a project and when you finish. The economy could change 3 times.
If someone wants to get into the community development investing space, where would you advise them to start and cut their teeth?
I think it's a combination of 2 things. One, they need to spend time understanding and knowing the community that they're going to invest in. I think that's true of almost every investment. But the second is they have to understand the technical side, just like my first boss said, you don't know much about banking. I think they need to spend time understanding how capital markets work overall, why they work and what the tools are. But they also have to understand what some of the barriers are for the communities that are being underserved and how to bridge those gaps and bring the two communities together. I mean, Bobby Kennedy, when he founded Bed-Stuy Restoration, he had a great comment. He said there are three pillars. There's the community and there's private capital. And then the role of government is to bring those two pillars together in a way that's productive. I think that prescription still works. Having the various parties be amenable to that collaboration and getting them all on the same page is the most difficult part, is because sometimes they all might want the same end product, but they have different ideas on how to get there.
Ron, I've really enjoyed this. I want to thank you a lot for your time today. We covered an awful lot of ground here. You've got some amazing stories to tell, and I always love having people on who've had a front row seat as so much of this stuff in historical perspective was evolving, being developed. And yeah, you played a primary role in developing community development investing in America. So I've learned a lot. I appreciate you coming on.
Thank you for having me on and giving me the opportunity to share my story.
Now tell everyone what's the best way they can find out about all the great things you're doing at RBC Global Asset Management and community development and investing, and your websites and social media.
You can contact us on our website, rbcgamus.com, and look under impact investing. And we have two mutual funds. One is Access Capital Community Investment Fund, ACCSX, and the other is the RBC Impact Investment Fund, RIBIX.
The mutual funds, I mean, anybody can access that, right?
Yes. We have a retail share class. We have a investment class. We have different share classes.
Is that accessible directly through RBC, or is this through brokerage?
Through Merrill Lynch, through Schwab. We're on a lot of platforms. We also are in a lot of tailored programs where they'll construct an overall portfolio. So we're also a part of some of these balanced portfolio programs that people can invest in that are interested in things like ESG and impact investing and socially responsible investing.
And if someone is interested to reach out to you, what's the best way for people to contact you?
The best way would be through ron.homer@rbc.com, which is my email address.
All right, everybody, go to rbcgam.com. Lots of good information there. Click on Impact, and it sounds like there's some funds that anybody can access there and information on that. It's not often that we have investors in here that you don't have to be a qualified investor to get into, but this is one of these exceptions. So, Ron, thanks again for coming on.
Thank you. Thank you for having me. Enjoyed it.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.